do. But there's no formal requirement for disclosure on that.
All right, thank you.
I have a question, Gavin.
Any other questions?
Yes, I have a question.
Yes.
On the application of the agent versus the principal recognition of
Yeah.
revenues, I've seen people referring to US GAAP SEP 104 or EITF 99-19.
Yeah.
In your view,
Yeah.
when people do that in applying IFRS, do they have to apply that guidance fully? I mean, do you have to follow EITF 99-19 fully or not?
No, not at all. The interesting one there that you mentioned, and this is kind of like really relevant for sort of the software industry especially, in terms of kind of embedded maintenance within software contracts. And it's a very interesting question that you know, a lot of people, when they're looking at revenue recognition, will perhaps refer to US GAAP to give them a little bit more guidance on this whole whether you are agent or whether you are the principal. Well, US GAAP, because of its very nature, goes through a very significant number of examples of specific circumstances where revenue is occurring. And so it's not the case that you are following the US GAAP, it's almost that you're using US GAAP to try to establish the substance of a transaction. What you have is you have the idea of equivalence. So if there is no specific guidance within IFRS, you are allowed to have a look around and see what specific guidance actually exists. Providing it doesn't contradict substance over form, you can then apply that guidance. So to do with agent and principal, to also do with bundling and unbundling, there's quite a considerable amount of guidance within US GAAP. I mean, I'm thinking particularly of things like the telecoms industry. US GAAP has got quite prescriptive information on how to recognise revenue in the telecoms sector, and whilst we have substance over form and the idea of bundling and unbundling under IFRS, there's no specific guidance for telecoms. So a lot of people in the telecom industry look at US GAAP to give themselves a little bit more guidance on how to deal with the bundling and unbundling issue. But fundamentally, substance over form is still the winning answer. So you can only look to US GAAP when it doesn't contradict the substance of the transaction. And that's the situation that you are sort of mentioning there with that particular SFAS, is it doesn't actually contradict substance over form, it's just applying a little bit more of a kind of like a matrix approach to how to actually deal with whether you are agent or whether you are principal. But fundamentally, you can use it as guidance, but it's guidance, it's not.
No, just like I have only this schedule for today. I want to have something like this and have for the rest of the session, like 5, 6 sessions. Would be good. Something like this would help.
Yeah, let me check.
Will you be with us for the all sessions or
No,
no? That's okay.
I'll be in Washington. Why don't you do one thing? Send an email, please,
Okay.
to the Teacher Support Center. Copy me.
Okay.
You have my email address?
I'm not sure.
mrahman@worldbank.org. You know, you have my email address where I show you. Copy me, then I'll make sure that... Oh, it's not here. It is somewhere else. Okay, we are going to start our second half of our program. So I'm now inviting our instructor in London to start. Thank you very much.
Okay, hi there. A second session. Like I say, hopefully you found the first session useful, and yeah, we covered a fair amount in terms of accounting policies, etc. I can see the Philippines are just not quite in yet, so sort of I'll just sort of very quick recap of the first session whilst they're all getting their seats. So we talked about accounting policies, and we talked about revenue recognition. Two very important areas, and the sort of home study aspects of sort of understanding the financial position and kind of financial performance of an entity, and understanding the substance, all build into what we've already seen so far. And that's one of the reasons why we wanted to cover revenue recognition fairly early on, was just to make sure that everyone was fairly comfortable with the ideas of substance. Now, like I say, I'm almost certain that you'll have some questions on that, and the opportunity sort of to cover those kind of things could well be on the 2 hours following this session. Literally, as we go offline here, I'll be flipping my computer over and going into the emails, and so I'll be able to respond sort of fairly quickly. Obviously, if a number of you have got the same sort of questions, what I'll do is I'll reply to everybody, as I did yesterday with one of the emails about US GAAP, just to try and make things sort of a little bit sort of more easy. But my apologies if it takes sort of like half an hour or so to get around to your email. Obviously, if I've had 20 emails all come in at once, all asking for detailed explanations, I will work my way through them. If you send your email within the 2 hour period, I will make sure that I answer it, even if I don't get around to answering it within the 2 hours. Okay. Right, so what we're going to be covering now, and again, if I can just sort of ask you if you just wouldn't mind turning mobile phones off, because otherwise it is distorting around all of the different locations. That would be very much appreciated. Right, so what are we going to talk about now? We're going to move on to sort of chapter 7, which is property, plant and equipment, which begins on page 88. Chapter 6 being the one that we're skipping, that was on inventory, and that's one of the home study chapters. Okay, so on to sort of the objectives, scope and definitions of IAS 16, so into chapter 7. When we start talking about property, plant and equipment, it's a very big area, obviously, for the simple reason that it's probably the main area that's even covered in the financial statements. You know, property, plant and equipment, traditionally in most organisations, will be one of the larger numbers in the accounts. It's also one of those areas where sort of the bulk of analysis and interpretation kind of involves. Return on capital employed, assets, turnover ratios, even gross profit margins, net profit margins. are all affected by what happens with property, plant and equipment. The rate you depreciate your assets at will have an impact on profit margins. Whether you revalue your assets or not will have an impact on gearing ratios and net equity ratios. So when you start looking at property, plant and equipment, we have to give it quite a considerable amount of respect, even though it's actually not that difficult an area. Most of the things that you've seen under IFRS are pretty much the same in most other accounting regimes. So a lot of what you're going to see in the next sort of couple of hours is actually going to be sort of like fairly familiar to you. However, the devil is in the detail on this standard. Most of the standard treatments are fairly easy to pick up. However, it's some of the detailed application which can cause you difficulties. So, first of all, what is it? Well, this is items of capital expenditure that we're going to put onto the balance sheet. They're tangible fixed assets. We'll be dealing with intangibles in a future session, but this is just looking at the tangibles. So what makes something a tangible fixed asset, or property, plant and equipment, non-current asset, to use the IFRS terminology? Well, first of all, it has to be an asset. Now, from your home study, one of the things that you will discover is the definitions of assets, liabilities, incomes and expense. And the definitions of assets include the right to probable future economic benefit as a result of past transactions or events, and where you have the rights and obligations, okay, or you have the rights to receive that future economic benefit. So, rights or access to future economic benefit, you control it, and it's as a result of past transactions or events. So if I buy a building, I can capitalise it because I can control what goes on in that building. It's as a result of the past event in the fact that I actually purchased the building, okay, and I control it completely, and I'm going to get the benefits. The second part that you need is you need to be able to measure it reliably, and with tangible assets that's not usually very difficult because it's usually a cash price or an open market value for it. So, what we're starting off with then is the classifications of assets. You've also got land and buildings, usually classified together. Okay. We also have sort of plant and machinery. We also have fixtures and fittings, office equipment, computer equipment. The standard is not really very prescriptive in terms of how you group these assets together. So you would normally group the assets in terms of similar characteristics. So computer equipment and office equipment, virtually the same thing, probably the same useful life, so therefore you would capitalise those together. It may even be that fixtures and fittings and plant machinery may even have a similar useful life and therefore be grouped together. So that's by way of an introduction. So now we need to move on to cost. What constitutes cost of an asset? Well, the standard itself in IAS 16, kind of round about paragraphs 6, 7, 8, 9, 10, 11 and 12, takes us through what can and what can't be included as cost. But your benchmark rule is that you can include all directly attributable costs. Okay? So any costs that are directly incurred as a result of acquisition, installation and preparing for use of that asset can be included as part of the cost, including things like employment costs. If, for example, some of your employees are used to install that asset, and that takes, say, a week to install it, then you can include all of their salary costs, including pension contributions and other contributions, as part of the cost of that asset. What you cannot include, however, is any profit measures that would normally be included. So if you, say, for example, have an installation team who are normally charged out to other entities, if that installation team installs your asset, okay, your normal charge-out rate would be 2 times their cost, you would not be allowed to capitalise part of that profit element. You'd only be able to include the costs associated with those staff, not their charge-out rates. Okay, so if you're using your own staff, you can include their cost only. Okay. You can include all costs associated with installation. So, for example, if you have a piece of plant and machinery, and in order to get that plant and machinery up and running, you need to put down some concrete foundations, maybe hire a crane to be able to lift it off the back of a lorry and put it into place in your building, then you can include the cost of laying the concrete, you can include the cost of hiring the crane to lift it off the back of the lorry. Even if you had to actually remove a section of the roof to lower it into place, you could include the costs of removing the roof and the cost of putting the bit of roof back on again, because all of those costs are directly attributable. However, you would not be allowed to include costs, for example, of the board of directors going over to another country to see a similar asset in use in order to make a decision about whether to buy this one or not. Okay, that would be a sunk cost. It's going to arise whether or not you actually go ahead and purchase the asset. So therefore those kind of costs cannot be included as part of sort of the cost of the asset itself. Likewise, any form of administrative allocation also cannot really be included. Okay. When you are including these costs, you're also not allowed to include abnormal costs. So for example, if you're having an asset installed and on one of the particular days there is incredibly heavy rain, and so all the workforce is sitting off on the side of the road waiting for the rain to pass before they continue their work, that cost would be seen as an abnormal cost and is therefore not allowed to be included as part of the cost of the asset. Okay. Like I say, for more guidance on that, there's a bit more information in your notes towards the bottom of page 88, and it gives you the paragraph numbers from the standard, which can be quite easy because they do give you certain examples. The other thing I just want to mention in terms of costs is the treatment of testing. Okay? With many assets, once you install them, they have to go through a period of testing to prepare them for use. And I'm reminded of a very old client of mine when I used to work in sort of professional practice, that was a printing company. And with this particular printing company, they installed a brand new printing press. And this printing press was huge. It filled kind of, about the space of, sort of an American football pitch. So it was a massive kind of printing press operation. In order to actually get the operating license, after it had all been installed and put together, they had to run a ream of paper and kind of like inks through the machine just to make sure that it was all working properly. Okay? Now that testing was required before it was given its operational license. So therefore all of the costs of that type of testing are allowed to be included as part of the cost of the asset. However, obviously they're running a lot of paper through a printing press. It makes sense to actually print something. And so what they did is they contacted a local charity and basically offered to do a huge amount of printing for them at sort of a very much a notional cost. There wasn't really any profit element. They did it very, very cheaply. But there was still a revenue element of that printing, in which case they can capitalise all of the costs of doing the printing, so the cost of the paper, the cost of the inks, the cost of the workforce that were required to work on that particular day. However, they must first deduct any of the revenues that they've received from actually printing those materials. Okay? So you actually are capitalising the net cost of doing the printing run. Now, what was quite interesting in this particular example is about 2 weeks after they'd done that, one of the parent company directors had come over to, as it was the UK, to actually have a look at what they'd just spent several £100 million on. Okay? And whilst it was there, the director said, oh, come on, what can it do? What level of output can it achieve? And so the production manager said, well, would you like to see it at full-scale production? Even though they hadn't actually brought any of the newspapers that they were printing into the new press at that stage. So the director obviously said, oh yes, I'd be very interested in seeing it run. And so they put on a ream of paper and they turned the speed thing right up to the maximum to just churn through huge amounts of printing. Now obviously the people who were waiting for their printing got their printing done a lot quicker, but obviously they didn't pay any additional fees. However, the costs of actually putting that ream of paper through meant there was 3 or 4 times as much wastage as normal. Those costs were not allowed to be included as part of the cost of the asset because they weren't actually necessary. It was just the director wanting to see it working at full capacity. So when it comes to testing, you can and should include costs of necessary testing in order for it to achieve health and safety clearance, operational licenses, safety licenses, etc. But you're not allowed to include any kind of what we'd refer to as optional testing, just to kind of see how good it is or to see what it can do. Okay? We then have to move on to self-constructed assets. Now, a self-constructed asset is determined in exactly the same way as any other asset that has been purchased. If you are constructing it, again, all attributable costs. However, you're not allowed to use a profit element. Again, a reminder of another old audit client of mine. It was a building company that used to build houses for people. And they decided that it kind of made sense, as they were a building company, for them to build their own new head office. And so they used their own existing workforce to construct their new head office. Because they're doing it for themselves, it's not covered by IAS 11 construction contracts, because that would only be used for when you're constructing the assets for other people. So because they're constructing for themselves, the costs were going on the balance sheet as normal. However, they were not allowed again to include any profit elements of the cost of construction. So they're only allowed to include the cost of the workforce and the cost of materials, not the amount that they would normally have charged to a third party for using them. Okay. When do you stop recognising costs? Well, technically when the asset is ready for use. Okay? A lot of people think that you stop capitalising the cost at the point where the asset is brought into use, but that's not the case. You actually stop capitalising the additional costs when the asset is ready to be used. The fact that it's not actually being used and you may be incurring some margin